morning. I'm Steve Bury. I'm the president of Discovery Institute, and it's my pleasure to welcome you to what promises to be what is a timely event and a timely book, Inflation by Steve Forbes, Nathan Lewis, and Elizabeth Ames. Steve Forbes needs no introduction, longtime friend of Discovery Institute. Nathan Lewis is a fellow of our Center on Wealth and Poverty and is the author of 4 books, including 3 on gold. And Elizabeth Ames is a writer and commentator and is co-produced a great documentary, In Money We Trust. And if you are not familiar with it, I would encourage you to take a look at inmoneywetrust.org, where you can watch the documentary. It's really fantastic. So our structure today is we're going to have about 20 to 30 minutes of discussion by the authors, followed by Q&A. You can use the Q&A button at the bottom of your screen to type questions, and you can do that at any time. And when we start with questions, Elizabeth is going to walk us through those, and I'll be back for a conclusion at the very end. So without further ado, I'm going to turn it over to Elizabeth. She's going to more fully introduce your speakers today and manage the rest of the event. So thank you for joining us.
Thank you, Steve, and it's very, very good to be here. When we first started talking about this book a little more than a year ago, people were just beginning to become aware of rising prices, but it was largely chalked up by the Fed and most experts to the disruptions of the pandemic. Today, we all know better. We were told originally that inflation was going to be transitory, but a year later, it shows no sign of slowing down. Maybe there was a downtick in the month of April, but as the Wall Street Journal and others have pointed out, that's not likely to signify a change in direction, and more likely further price increases lay ahead. The debate over whether or not inflation is transitory is just one reflection of the misconceptions that surround this subject. And they're the reason why we wrote this book. Inflation can be stopped, and it can be stopped quickly if we understand what it is. And before we get into our discussion, some background about the book. It's an accessible, wide-ranging discussion for a general audience. The chapters are pretty much what the cover of the book tells you. What is inflation? We have a chapter on history, not so great moments in inflation history. There's some touches of humor, as that chapter title suggests. We talk about why inflation is bad, which of course they say small levels of inflation are good, and that's not really true. How to end the malaise, what about your money and the way forward? There's even a picture in the book, if you just want to show it. Anyway, talks about sort of the Rube Goldberg-esque process of money creation. Anyway, I think you'd find it a very fast-moving, accessible read. But before we get into that discussion, a few words about my distinguished co-authors. Steve Forbes, as you all know, is chairman of Forbes Media, the foremost name in business information. He hosts the acclaimed webcast, What's Ahead, and is the author or co-author of several books, including Money. And that was the basis, as Steve pointed out just earlier, the basis of our documentary, In Money We Trust. He appears often on Fox and on other broadcast outlets. Nathan Lewis is among the world's leading authorities on monetary policy and economic history. He is the author of The Magic Formula, The Timeless Secret to Economic Health and Prosperity, Gold, the Once and Future Money, Gold, the Monetary Polaris, and Gold, the Final Standard. He publishes the Polaris Letter, a monthly investment newsletter available at newworldeconomics.com. I've been honored to work with these 2 brilliant collaborators, and now I'll throw out the first question. What is inflation? Steve, you want to take that?
I'll kick it off and then turn it over to Nathan. We point out in the book that in the popular mind, there are really 2 kinds of inflation. Non-monetary inflation, which can come about through market events. You have a drought that's going to send crop prices up. You have a war like we have in Ukraine, which can send food prices up. Or you have the lockdowns from COVID, which disrupted supply chains all around the world. And given the fact that countries had different rates of recovery, it created shortages and sent prices up. Then, of course, normally, if governments just let that work out, it will work its way through. The classic example is World War II. After World War II, we've had about 2.5 years of rising prices and dislocations as we transitioned from a wartime economy to a peacetime economy, going from making airplanes and tanks to refrigerators and cars. Not so easy to do quickly, but we did. Prices settled down, and the U.S. enjoyed a great boom going forward. The more pernicious kind of inflation is monetary inflation, which comes about when the value of the currency, in this case, the dollar, is lowered. It declines, usually because cash-strapped governments create money out of thin air more than the markets need. And so you get not only rising prices, but as we point out in the book, it has social impacts as well that are devastating, whether short-term or long-term. Those two kinds of inflations can coexist as they are today. They overlap. But I think in terms of grasping what needs to be done, it's good to have those two divisions so that way policies can focus on what's really there. And as we'll be discussing, Elizabeth alluded to it, governments don't cure the disease. They mistaken the symptoms for the disease, in this case, rising prices. That's a result of inflation, not a cause of inflation.
So, okay, Nathan, do you want to add to that, to the answer of what is inflation?
Yeah, I'll say a few things. I think Steve's point is certainly important. The term inflation kind of becomes this big stew pot where everything that could have any conceivable influence on prices gets thrown into. And one of the results of this is that we don't come to good solutions because we don't have a clear idea of what's going on. Now, let me say that sometimes you hear from the conservative side, well, inflation is everywhere, a monetary phenomenon, and that is happening now. But we also have some serious supply demand issues. Like Steve said, maybe we haven't seen since World War II. When the last time in your life have you ever seen car dealers with no inventory on the lot for a year, right? Never happened in my life. And what we could see that, but that sort of thing is happening in many sectors that we don't see for capital goods and stuff. We have some very strange supply chain issues that are much more persistent than they have been in the past and look like they're actually going to get worse. So I don't want to dismiss those things. It probably accounts for more than half of the recent CPI numbers. But then on top of that, we should not confuse the supply demand things for a whole different sphere, which is the monetary sphere, which has much more serious long-term consequences, I would say, especially if we repeat these patterns. We all know that central banks around the world, including the Federal Reserve, got very busy during COVID. Governments ran huge deficits, and rather unusually, central banks essentially paid for those deficits by purchasing government bonds and through the money creation process. And not very surprisingly, this has led to a drop in currency values. And it's real simple to understand. If currencies drop in value, then prices rise to compensate, and this takes a period of time to accomplish. And that is another thing that's definitely happening now and is leading to the highest CPI readings in roughly 40 years.
Well, isn't this the latest development in a 50-year story of inflation? I mean, I think our book brings that out a little bit. Do you want to go into that a little bit? This is really the latest and most severe manifestation recently, but the story began 50 years ago. Do you want to go into that a bit?
Steve, go ahead.
1971.
Well, as we point out in the book, you can have a hyperinflation like we had in Germany in the early 1920s. There was a wonderful book written by Adam Ferguson called When Money Dies. And he points out that Germany was probably the most law-abiding nation on earth. They obeyed all the rules, all the laws. With the hyperinflation, which made a mockery of traditional values of how to get ahead, people turned to crime, people turned to shortcuts. Morals went by the boards. Everyone lived for today because there was no tomorrow. We see that in a hyperinflation. You see it in Venezuela today. But you can have a long-term social impact since the 1970s, where we had periods of relative stability in the late 80s through the late 90s. But overall, during that period of time, the dollar lost between no matter how you compute it, whether it's 86% or 98%, but a huge loss of value. But because it's over 50 years, the pernicious impact is not clearly seen as you would in an immediate hyperinflation. but nonetheless, the dollar has lost value. And two statistics we have in the book that Nathan dug up was that after World War II, we had the Bretton Woods gold standard. And from the late 40s to the late 60s, the average growth rate of the American economy was 4.2%. Since then, before COVID, it went down to 2.7%. Now, that doesn't sound like much in and of itself, but when you accumulate that over 50 years, it's devastating. One other statistic, household income, median household income today is about $67,000. If we'd maintained average growth rates, historic growth rates in this country, that median income today would be 100 to 110,000. Now, people would still have problems, obviously, but people, I think, would be a lot better off and happier with stable prices and with incomes $30,000 to $40,000 higher than they are today. It also undermines the social fabric, as we saw in Germany. I'm able to deal with people I don't even know, but through the trustworthy medium of money, we can do very sophisticated supply chains, networks, deals. And when you cease to trust, when money becomes something you can't trust anymore, it ends up, you start not trusting other people. You realize the people who speculate get ahead faster than those who pursue honest work or try to come up with good services, products, and new services. And so the fabric of trust in the society is eroded. And that's what I think is the source of a lot of the social problems that we have today, is the breakdown in the trust in money, and leads to the breakdown of trust in the society as a whole. As we point out in the book, countries that have that traditionally trash their money, consistently trash their money, have very high rates of violence, much higher than in countries that try to keep stability, try to keep a stable money.
Well, what I was wondering if maybe Nathan can walk us through what has happened since 1971 when we went off the Bretton Woods gold standard. This is really a larger story than just the last several years. I mean, maybe Nathan can walk us through that.
Exactly. And that's something that every American should be aware of. It's one of the most important events in US history and actually world history of the last 200 years. Up until 1971, from the founding, 1789, the United States had a stable money policy. The idea was to keep the dollar as stable as possible. And the way this is accomplished in the real world, the practical sense, was to link the value to gold. And the United States did not always do this. There was inflation during the Civil War. But as long as we did this, we never had an inflation problem. And after nearly 2 centuries of doing this, until 1971, became the wealthiest country in the history of the world, wealthiest country in the world at the time. It worked extremely well, just as the founding fathers expected it would. And then there was some, kerfuffle going on in 1971. And we got off this sort of accidentally, really. There was no problem. The 1960s was a very prosperous decade, but we got off this, and now we have the floating fiat system, the PhD standard, it's been called. We no longer base our money on gold with the goal of having stable value. We base our money on the opinions of central banker guys who make stuff up as they go along. And not stable value is not even really the goal. It's stable. The goal is to appease political pressures and keep the stock market up and reduce unemployment and play with interest rates and all these other things except for currency stability. And the long-term result, the short-term result of that is that the values of currencies go up and down. That's what floating means. The long-term consequences is that the value of our currencies have declined a lot. I think probably the US dollar today is worth about a 50th of what it was worth in the 1960s. And there's actually a person who wrote a very excellent book about that. Is George Gilder, also of the Discovery Institute. It's called The Scandal of Money. It's from 2016. And he sort of updated a point which has been made in the past, in that economies grow through rational economic calculation, profit and loss, returns on equity, stuff like that. And if the currency's value is going up and down and sideways and stuff, it becomes very hard to make those calculations, and you end up with a lot of booms and busts and investment in bad ideas and underinvestment in good ideas. And the consequences are mediocre economic performance. Maybe, if things get really bad, disastrous economic performance.
Well, I'm just going to move on a little bit to one of the other concerns of our book, which is why inflation is bad. Now, you would think that that would be, a no-brainer, but the Fed insists that small amounts of inflation are good. I'm going to throw this one over to Steve. Why is this misguided?
Well, it's misguided because an unstable currency is like a virus in a computer. Our whole economy runs on the basis of prices, telling you what people want, what people don't want. And if that information turns out to send false signals, you get bad investment, you get people wondering why the world doesn't seem to work properly. A classic example is the 1970s, when oil went from $3 a barrel to almost $40 a barrel. People thought, oh, we must be running out of this stuff. So a massive amount of money went into energy. And then when inflation was brought down in the early 1980s, oil went from almost $40 a barrel down to $10 or $12, finally stabilized at $20 to $25. Again, in the early part of the 21st century, oil was at about 25. The dollar was reduced sharply in value, and oil suddenly went up from $25 to $100 a barrel. That wasn't so much oil becoming more valuable, it was the dollar becoming weaker. So you don't get a properly functioning economy if you can't measure what the true value of things are, what people think true values are. And as we mentioned before, what it does to social trust, if you would feel that you get ahead by cronyism, by speculation. Paul Volcker in our film, In Money We Trust, says at one point, where I forget what the number was, 30–40% of profits came from financial institutions. He says, I love financial institutions, but this is not normal. So you get distortions in the marketplace. When the Fed did so-called quantitative easing after the crisis of 2008, 2009, where they artificially kept interest rates low, they distorted the credit markets. For example, why would Apple, which is a veritable money machine, cash machine, of getting excess each year of tens of billions of dollars, why would they go out and issue tens of billions of dollars of bonds? Why? Because the money was virtually free. They could use it to pay dividends. They could use it to buy in stock and make their stock more valuable. They wouldn't have done that if you had a stable value, normal interest rates, but if you're giving away the money, corporations get it and small businesses suffer. So the whole fabric of society, people don't trust the verities anymore, and you get strange behavior, and people react because they think that things are unfair and they don't understand why. Just imagine for a moment if the Federal Reserve was in charge of the Time Bureau and they decided that a way to improve productivity is to add 30 seconds a day to the hour. So that way people work longer at the same pay. And the Fed people would say, see, we're improving productivity. But people would soon sense something is not right. And they would react adversely to it. That's what inflation does.
Well, the thinking at the Fed seems to be that 2% inflation is stability and that you need to create more money to stimulate the economy. Why is that wrong? Who wants to take that?
I'll remark on that. And as I mentioned, since 1971, we've seen very clearly for every country, not just the United States. The United States has actually been the least bad. There's been a definite long-term tendency for currency values to decline, and the flip side of that is a long-term tendency for prices to rise because your currency is not worth as much. And this arises in part from economic theory. The theory of why we have floating currencies at all is the belief that we can fix economic problems with easy money, whether it be lower interest rates or more money creation or lower foreign exchange values or some variety of easy money. We can jigger the macroeconomy rather than just doing, investing and having good ideas and the virtuous stuff that makes people wealthier. And so this kind of comes out as, oh, well, we need this background level of low inflation. And over time, it makes people poor, right? You have to get raises constantly over time just to kind of keep up because your currency is steadily losing value.
Yeah, it goes to the theory called the Phillips Curve, which a lot of economists now say, oh, they don't really believe, but the Federal Reserve and most economists still believe it. And that is there's a trade-off between inflation and unemployment. That's one reason why the Fed came up with this 2% inflation number, is that if you have inflation, you have lower unemployment. If you have lower inflation, you have higher unemployment. And so they figure that this is why the Fed is now on a course not to overtly stabilize the dollar, which is what they should be focused on. It is to slow the economy down. That's why they're happy that the housing market seems to be cooling off. They want less economic activity. They figure that cures inflation. Well, prosperity does not cause inflation. If people are doing well, the Fed says, oh, we have an overheating economy, but just ask yourself, if your income is going up, do you start to sweat at night? Do you start to feel overheated, like you're standing out in the sun? Oh, take my money away, I'm overheating. It's preposterous. If prices are going up because people want more of something, that's a signal that you make more of what people want, or find cheaper ways to produce what people want. That's how an economy operates, but that seems to be ununderstandable by our gurus at the Fed and elsewhere.
I mean, should we be distinguishing between low and higher levels of inflation? I mean,
No, we should not have inflation or deflation. We should have flation. And that is, prices may go up and down through supply and demand, not through the vagaries of the machinations of the Federal Reserve or other central banks.
so how does inflation impact the fabric of society? Nathan, do you want to talk a little bit about that?
Yeah, we've made some of the points already, but I think you can go from somewhat theoretical considerations, like I was talking about, rational economic calculation, malinvestment, these kind of things, and then move to very practical considerations. Well, you get paid in money, so if the value of your money goes down, doesn't the value of your income go down? Yeah, it does. Doesn't that make you poorer? Yeah, it does. Just look at any country, Mexico, for example. Mexican peso goes down in value again. Doesn't that mean the Mexican worker is poor? Yeah. You can't get richer by making people poorer. Asset values go down, value of all fixed income instruments goes down, and then they recover afterwards. But then what you're burning is you're burning time. All right. If you value of stuff goes, like your salary goes down, then you work really hard and you get a raise, and it just kind of gets you back to where you were. Keeps your head above water. Well, you just took 10 years to go nowhere, which kind of sounds like the American worker of the last 30 years. You could, even if you had been making 3-4% growth, real growth, as was true in American history before 1971, you'd be pretty far ahead in 10 years. You wouldn't be just getting back to flat. So if you just think of it that way, it's very clear. I think you can't devalue yourself to prosperity, is the way they used to put it.
Steve, you say something very interesting very often. You've said that we're seeing Weimar in slow motion. You want to elaborate on that?
Well, with a hyperinflation, like what happened in Germany in the early 20s, or what you see in a country like Venezuela or Lebanon today, or Argentina, is when the currency falls rapidly, people immediately see the consequences of it. They feel it right away. Whereas if you do it slow motion, like that old myth about the frog in boiling water, you don't realize that you're in hot water until it's almost too late. It's very gradual. And you do have periods of semi-stability. Alan Greenspan, who was the head of the Federal Reserve from 1987 to 2006, he liked the gold standard. He said we couldn't bring it back, but he had sort of a semi-gold standard from the late 80s to the late 90s, where the gold roughly and commodities roughly paralleled the dollar, a sloppy gold standard, you might say. And we had what the period called the Great Moderation. Then for some reason, maybe pressure from the Treasury Department, Greenspan lost sight of his own insights. And we got first a deflation in the late 70s, commodity prices collapsed, and then a devaluation of the dollar in the early 2000s, which is why oil went up fourfold, copper went up, wheat went up, corn went up, and most ominously, housing went up. And we saw where that led, leading to the crisis of 2007 to 2009. So slow motion, yes. And Keynes was right about inflation. He said not one in a million understands the process of destruction that's going on. What he didn't realize was that it doesn't have to be in a hyper environment. It can be slow motion, where you do have periods where things seem to be going well, and then suddenly they go off the rails. And there have been studies that show that since we went off the gold standard, the Bretton Woods standard, we've had more financial crises, more financial troubles than we did when we had stable currency. And as George Gilder likes to point out, one sign of the wasted effort and brain power is that now I think the amount of currency trading a day nominally is now $7 trillion. Well, on the gold standard, you had no real commodity trading. I mean, exchange rate trading, trading money, because they were relatively stable in value. You get occasional devaluations from the French or the English, but those were periodic. Most of the time, things were fairly straightforward, fixed.
So that gets us to fixing inflation. Why do governments are they so rarely able to deal with inflation, and what's the best way to fix it? Nathan, you want to take that?
Well, let's set aside for now the supply demand issues, which are real today. And I think people understand how they could be fixed. And no doubt the government's causing some of them and could do a better job. But I want to focus on the monetary topics. And if you just think of the monetary inflation as being essentially the consequences of a decline in the value of the currency, and I mean like the foreign exchange value of the currency. For example, we use the example in the book of the Mexican peso going from about 3 in the 90s to 20 today. Well, guess what happened to prices in Mexico? It probably went up about 6 times, right? And that's in fact what happened. If you want to stop, or hyperinflation in Germany, if you want to stop it, you just have to stabilize the value of the currency. Sometimes people talk about, oh, wait, there's inflationary expectations and blah, 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 and 1,001 excuses. But one of the interesting stories is not only the hyperinflation in Germany, how it started, but how it ended. They just said, you know what, this is ridiculous. We got to stop. And they got a guy to do it. And they set him up in a broom closet in the Ministry of Finance with one secretary. And on Monday, they were at hyperinflation that we still talk about today, like, billions of percent hyperinflation. And on Friday, they're on the gold standard. And inflation was gone. If you stabilize the currency value, at least you're not going to cause any more inflation. Right now, you might have prices adjusting to the previous decline in the currency, but that's all you have to do. You just have to stabilize it. Whether you stabilize it in kind of a seat of your pants, make it up as you go along in formal way, like Paul Volcker did in the 80s, rather sloppily, but effectively. Or you do it very formally, like establishing a new gold standard system, or for somewhere like Bulgaria, which had hyperinflation in 1997, a German mark-based system, it can disappear in a matter of hours. It's that simple.
And the thing to keep in mind is that when you stabilize the currency, it does take time for the economy to adjust to the stability. We saw that in the early 80s when everyone expected, before Volcker put the brakes on, the prices, because of the previous 12 years, prices would go up 8 to 10% a year forever. So investments like forests and farmland and the like that look like sure things going up 8 to 10% a year suddenly went in the opposite direction. The inflated values were stripped away. You had terrible recessions in Texas and Iowa, but the US economy as a whole moved ahead. So you don't have to, one of the things people confuse is they think austerity cures inflation. No, stable money cures inflation. You may get sectors of the economy that have to readjust to a normal environment. What worked when you had inflation won't work in a normal environment, but those things will work themselves out. And if we just step back and let it work out, as Bulgaria, of all countries, showed, by golly, you can move ahead very nicely, very quickly.
Now, I think I might add something about austerity, because that's kind of a principle that keeps coming up. And we're having it right now. Like the Federal Reserve and everyone around says, well, what we really need, we have these shortages, which is driving up prices, like for used cars. But if people just didn't have a job, then they wouldn't have any money, and then they couldn't buy things. And so the shortage would be a surplus, right? It's kind of the thinking that's going on. That's very stupid. or, and they're talking about raising interest rates, but it could be raising taxes. They actually tried that in the 70s and other places. That's not, I'll tell you what happens. So you solve inflation by stabilizing the value of the currency. Now, what happens when you have austerities? You have a terrible economy. What happens when you have a terrible economy? Well, all the guys that said, well, we can solve the terrible economy with easy money, everyone starts listening to them. What do you have next? Another round of inflation. Maybe that's going to happen to us right now, because what's going to happen?
Stimulus bills.
You have the stimulus bill.
Yes.
And after we have our recession over the next 18 months, then we have the stimulus, and then we have more inflation. Could happen. So actually, austerity has nothing very much to do with stabilizing the currency's value. That's the central bank's job, not the Treasury. But it can lead to a new round of inflationary response to the austerity recession.
Well, that brings us to a question from one of our viewers, which was perfect lead-in. What's preventing the US from implementing the fix for inflation? Does our massive national debt have something to do with it? If so, how do we deal with national debt without inflating it away?
The way to do it is through economic growth. Take the US after World War II, our national debt was about 121% of GDP. We ran up a huge amount of debt saving civilization. And after the war, we got rid of wartime controls, actually had a big tax cut in the way people calculated their incomes, couples, deregulation, and government spending went down. And we had semi-good finance in the 50s and 60s. And by the end of the 60s, the national debt as a percent of GDP went down to 35%. Then we went off the gold standard, and we've seen what's happened since. So the way you deal with the national debt is you don't put in austerity, you don't raise taxes. All you do is be good on spending, reduce tax rates, go for deregulation, removing stupid barriers to people doing commerce. And by golly, over time, it works. Another example quickly was Britain after the Napoleonic Wars 200 years ago. Experts calculate that their debt was about 225, 250% of GDP. 100 years later, when the First World War hit, I think debt to GDP was about 25%. So over time, when assets grow faster than liabilities, wonderful things happen.
So here's another question. If I understand correctly, if the Fed cuts back on QE, printing money, and minimizing interest rates, this will cause commodity price decreases and would be harmful for gold or property prices. On the contrary, if the Fed continues to inflate the dollar, holding commodities like gold or property will be an essential hedge against losing wealth. Which of these two options is most likely in for our country? Nathan, do you want to take that?
I tend to be of the opinion that we are, this is predicting the future, often wrong, in a 5 to 10 year, let's just say 10-year period of resolution of some issues that have been around for decades. And I agree first with Steve that historically the way to solve a high debt problem is to have a stable currency and a strong economy, which means lower taxes and not austerity. And the United States was extremely successful with that. One example, unfortunately, I think one of the reasons why the United States was the leading country in the world during the middle of the 20th century is because we were so much better than the other governments. Today, we're kind of a little more similar to the other governments. And unquestionably, the very high debt levels, the persistent deficits, all the entitlement commitments and tendency to add on top of them whenever there's a recession and spend even more money, is creating a political pressure, yes, to essentially inflate it away. And this is almost being formalized in the form of modern monetary theory and other kind of crazy rationalizations. Because you can't just go on TV and say let's just inflate it away, right? You have to have a better excuse than that. So they make some. I agree. The political time for stable money, let's say a new gold standard for the United States, is probably not now. But if you look at what's happened in the last 30 years, the countries that get it right after they have a crisis. And the countries that really got it right in the last 30 years is actually the former Soviet economies. They had hyperinflation and terrible taxes in the 90s. And they were the ones who actually adopted the Steve Forbes flat tax during the 2000s. They were the ones who said, we're going to forget about floating currencies. We're just going to link our currency to the Deutschmark because it's pretty reliable, just as we used to link our currency to gold because it's pretty reliable. They did that, and they had phenomenal economic performance for about a decade as a result of that. So we might have a crisis, but out of that, we might have an opportunity to do what now seems politically impossible.
And one thing to keep in mind on investing in an inflationary environment, which you touch on in the book, first, never think of investing in gold. Buying gold, which you should do in this kind of environment, is an insurance policy against the proclivities of mistaken policies of our leaders in Washington and elsewhere. It's an insurance policy. And in terms of hard assets, one, you have to be careful you have the right hard assets. For example, today, some people feel that commercial real estate, which is a hard asset, may be overbuilt in places like New York and San Francisco. As leases come due, even if the currency is declining in value, if people aren't there to release this vast office space that has been built and is not used anymore, the building owner is going to have a problem. So you got to pick your hard assets that you think are primed to benefit from inflation. And then another thing to keep in mind is eventually the inflation will get conquered. Eventually they'll stabilize their currency, stabilize the dollar. And then the things that worked during inflation will bite you in a non-inflationary environment. I mentioned energy. Texas was in a depression in the 80s. Iowa, which was once a very red state, farming was devastated with the fall in land prices and commodity prices. And in 1988, it voted at a time when Republicans were winning the presidency by a landslide. Iowa voted Democrat. So what works in one environment may not work in another. And by the way, farmers in Iowa and elsewhere did learn that lesson. In the early 2000s, when commodities shot up again, the Farm Belt for a while benefited, but farmers were very careful not to take on a lot of debt because they knew that things can reverse themselves. And indeed, 2011, 2012, for a variety of reasons, agricultural commodity prices went down, but you didn't have the acute crisis in the Farm Belt that you had in the 1980s.
Here's a question about the Fed. Federal Reserve assets were $1 trillion in 2008, 4.5 trillion in 2015, and 8.9 trillion now. Is the right strategy to reduce this or just keep it at this level?
That's a complicated topic. And I think there has been we didn't touch on it too much in the book, but there has been some new banking regulations which have been phased in over the last decade, which now require banks to hold more cash than they did prior to 2008. And so obviously the cash has to exist, and central banks essentially had to create it. So that absorbed a lot of that money creation. We've obviously gone overboard, or we wouldn't be having this inflation problem today. The quantity of assets is not in itself such a big deal. The question is using that quantity to manage the value. We want the value to be stable. You can have an unchanging quantity of assets and have the value collapse. You can have a growing quantity and have the value be stable. So you just have to find the solution that creates the stable value.
And given what the Fed has done recently, probably if they were focused on the value of the dollar, they could probably run down that balance sheet without too much trouble. But Nathan touches on an important point: supply and demand. If you look at the money supply of Switzerland, you would think that country must be having a hyperinflation. But the reason they have a large money supply is that for 100 years, Switzerland has managed its currency better than anyone else in the world in terms of purchasing power. So it's a desired currency around the world. People love to have the Swiss franc. So because people trust the franc and trust that the Swiss will continue to be good stewards of their currency, it's a desirable one to hold. Whereas you take a country like Canada, which is much larger in terms of the population and the economy than Switzerland, has a much lower money supply because people don't really want Canadian dollars unless they have to.
Yeah, it's somewhat counterintuitive that the currency that is the most reliable has the biggest supply because it has the most demand. You can actually have a faster growth rate of supply if you've proven that you're a good manager of the currency than if you could have a supply of zero, or growth rate of zero, but if you've proven that you're just kind of throwing the currency to the dogs, it'll fall off a cliff. So anyway, the point being is that this is actually an important point because in economic theory, there's a way too much focus on supply alone. This is the monetarist view. It's like, well, 5% growth is just right and 7% growth is too much, or 3% growth is too much, or not enough. No, you want to have a stable value. And you accomplish this by managing supply. And if you are successful, then whatever the supply is the correct number, basically.
And that's what happened in the 1970s. If you look at the growth of what they call base money, that is currency in circulation and bank reserves, that's something the Federal Reserve or any central bank can control directly. The growth was not good, but not bad, far less than what we had in the 2000s. But you got a rip in the decline in the dollar because people felt the U.S. did not know what it was doing, that it was pursuing spending and tax policies that were going to undermine the economy. And so the value of the dollar fell down. And we didn't know how, and that's a key thing in going back to a gold standard. You have to have people who understand how a gold standard works. And clearly our policymakers during much of the post-World War II period did not understand what made a gold standard work, which is why there was this focus on balance of trade, what we're spending for troops in Germany. Were there too many dollars floating in the world? Why were people turning in dollars for gold? Well, they're turning dollars in for gold because they didn't feel we knew what we were doing. If they trusted the dollar, as they did in times past before that period, they would own the dollars where they could earn interest, buy good assets instead of holding a bar of gold that had no cash flow and paid no interest.
That's right. Steve mentioned that if you actually look at the growth rate of the Fed's balance sheet, or since that was mentioned, in the 1960s, when the dollar was more or less fixed to gold, the growth rate's about the same as it was in the 70s when you had terrible inflation. It's also about the same as it was in the 80s when the inflation went away. So once again, it's about managing the balance sheet correctly to achieve the result of stable money, not necessarily because 8% is enough and 5%, 5% is not enough or something like that.
Another question from a viewer, is there something, however minimal, to be said for crypto and so-called digital monies, even with their faults?
Well, the invention of cryptos, starting with Bitcoin, was what you might call a high-tech cry for help, since governments were routinely trashing their own money. The problem with Bitcoin, and this gets to the point that Nathan just made, is yes, it has a fixed supply that can be mined, but the value goes up and down worse than a roller coaster, and so it can't be used as money. You would never do a mortgage based on Bitcoin. If you'd done that, say 3 or 4 years ago, say for $250,000, you would owe the bank today $10 or $20 million. So you couldn't do a long-term contract in Bitcoin. Its volatility emphasizes what's wrong with the government currencies today. What is coming out of the whole crypto thing is the creation of a new technology and blockchain, which has great potential in making contracts better in the future, more durable, in payment systems being far more efficient than they are today. So the thing to watch is stable coins. And stable coins have gotten a bad rap in the last couple of weeks because they lied. They said that they had certain assets backing up the cryptocurrency. Well, like a bank that didn't have the cash on hand but had the liabilities, people's deposits, and they had a run on the bank. They had a run on these stable coins. But if the stable coin is tied to an asset like gold or a dollar, and they have transparently, openly have the assets to back that up, I could see the time come when, as it becomes easier to do transactions with the cryptos, you could see a challenge to government money from a truly well-managed, well-constructed stable coin. But we're not there yet.
So why is it, and a question that I'm going to throw out there, why is it that the policy community on all sides these days seems so intent on not considering, on canceling the idea of a return to gold?
I would, it's interesting when there's surveys of academic economists, and there's literally 100 out of 100 economists against gold standard. Now, this is something that we actually did for nearly 2 centuries and became extremely wealthy doing it. So what exactly, you think you get one fan? I mean, you don't say like, I think Michael Jordan is the worst basketball player in all of history, right? Usually success gets some respect. Unfortunately, a lot of it boils down to, as Jim Grant said, you either have the gold standard or you have the PhD standard. You either have currency based on gold, stable value, depoliticized, automatic, or you have a bunch of PhD guys make it up as they go along and jerking everyone's chain all day. Well, guess who loves that? The PhD guys love that. And the government guys love that because, just the government loves to have more power over you. So that is clearly sort of in the past, government said, you know what, we want to run things on good principles. Today, we have much more reliance on expedience, and they don't want to give up that power.
And where it really began, these theories of easy money and cheap ways of achieving prosperity have been around for centuries. Nathan discusses that in his History of Money. But what really did it in was the Great Depression, which was seen as a failure of free markets. Markets are inherently unstable. Somehow gold contributed to prolonging the depression. And so the idea grew that government had to be actively involved in the economy to keep it on the rails. Keynes got the idea across that a bunch of wise guys, wise men, now we have to say wise whatever, people can guide an economy. So you have Janet Yellen talking about, we have the tools in the toolbox to make sure the economy doesn't go ahead too quickly or go too slowly. All that grew out of the Depression and an utter misreading of what brought on the Great Depression, and not understanding what made possible the previous eras of prosperity. And Nathan makes this point too. After World War II, everyone realized that the chaos of floating exchange rates in the 30s was not good, prolonged the economic distress. And so he went back to a gold standard called Bretton Woods. But at the same time, policymakers in most countries were intoxicated with the idea of manipulating their economies by manipulating interest rates, spending levels, and the money supply and things like that. So you had an utterly contradictory approach. On the one hand, if you want a gold standard, you have to have monetary policy just focused on keeping the gold standard. You can't play these other games. But countries wanted to do both. One of the most chronic ones was Britain, which had one of the worst growth rates until Margaret Thatcher came along. But we saw it here in the 1960s. Countries wanted to both have the cake and eat it too. But in the real world, you have one or the other.
Here's another question from a viewer. What would it actually look like if we were to reinstate a gold standard now? What would the next 5, 10, 20 years look like? And are there any better ways to stabilize a currency than a gold standard?
Well, it could look however you like. When paper money first came out in the 17th century, people thought that was really crazy, right? They had gold and silver coins for hundreds and hundreds of years. They go, well, we'll just use this paper instead. It took a while for people to get used to that. And today we're kind of used to that, but maybe we'll just be using our smartphones, but it'll be linked to gold. And gold money, the service developed by James Turk, is kind of an example of that. And there are gold-based stable coins right now, and they aren't that popular yet, but Tether, the USD stablecoin wasn't that popular a few years ago either. So it might actually, it probably will be something that's essentially like on an app on your smartphone, because making non-counterfeitable banknotes is actually pretty difficult, and something that sort of only governments do. So that's what it could look. But in terms of other solutions, can you make a more stable solution than gold? Well, two things. We did the gold thing for hundreds and hundreds of years, and it worked extremely well. There was no real problem that we had to solve. It was not perfectly stable, but it's stable enough. We know that. We tested it. And the other thing is in the last 50 years, since 1970, no one has even come up with a proposal, not even a proposal, not even something we could even try and find out it doesn't work, to make something that is more stable than gold. There's a zillion proposals. Every assistant professor who wants to push his career ahead, has some idea he made up while sitting on the potty. They're all proposals of economic manipulation, not stable currency value. It does seem like people are not even capable of making a white paper that addresses this problem. So it appears to be completely impossible to beat gold.
But this is why a book like ours and some of what Nathan has written and a handful of others, I think, will gain adherence. That's why we keep pushing it, because the time will come when people will finally say, what we're doing is not working. Let's try something else. One good thing about the US is we're a very practical people. We don't hesitate to turn against eventually experts, sometimes more slowly than we should, but eventually I think it'll happen. And the essence of the gold standard is very simple. Let's pick a number, $2,000 an ounce. If it goes above 2,000, there's too much money creation. If it goes below 2,000 for a period of time, you're not doing enough. So keep it focused on the 2,000. And what may push us to a gold standard, and Nathan just hit on this, is the rise of stable coins that are tied to gold, with a technology that makes it easier and easier to use for commercial transactions, especially longer term contracts, which governments will try to ban by banning them and fighting them, but maybe the marketplace. Just as I'm old enough to remember in the early 1970s, when money markets were invented, thanks to technology, where you could put together commercial paper and other short-term assets, and people could get marketplace interest rates for buying a fund with $500 or $1,000. Before that, people forget today, interest rates were set by the government. Banks could not pay above a certain interest rate on bank deposits or bank CDs, unless it was 100,000 or more, which would be like $10 million today. So the money market funds, the banks hated them, the regulators hated them, but the technology came along and blew away what they called Reg Q, or the overt regulation of the interest rates that banks are allowed to pay on CDs and on deposits. So I'm hoping that we get something similar to what happened with money market funds coming out of thin air and blasting away the whole regulatory structure.
Can I just, one last question, just to wrap it up. We've seen about a 40% increase in the money supply in the last 2 years because of spending government on COVID relief and the inflation that's resulted. What do you, both of you, see? What's the scenario you both see for the next few years? Is inflation going to get worse? Is it going to start to wind down? Where are we headed? Nathan, you want to start that?
Yeah, we did have a lot of money creation around 2020. And there was definitely kind of a step down in currency values around the world. For right now, the last several months, I think the Federal Reserve knows it went overboard and has wanted to keep any additional inflationary pressures from affecting the U.S. economy. And I think it's been pretty successful at that. So in a sense, you could just kind of keep doing as they're doing, and maybe it'll be okay. But I think, I think we are getting into a situation, and it'll be more prominent. There'll be a big fork in the road, I think, in the next recession. If we do what we did in the last recession, or even if we did like a third of what we did in the last recession and spend money like crazy and print out of nowhere, people are going to look at that and say, okay, whatever trust we used to have in you, I'm going to toss that in the trash now. And we might get into real trouble.
Well, just want to add just to Steve's part of the question. The market just has been, plunging the last couple of weeks. Is that because they see more inflation in a recession? Where are we headed?
I think the markets are volatile and have been for 2 months on a downward trend, precisely because they think the Federal Reserve is going to engineer a slowdown. When the Federal Reserve says soft landing, in the real world, that usually leads to a crash landing. So if you ever hear of a Federal Reserve official trying to pilot an airplane, don't go on it. They don't know what they're doing. So they think slowing the economy is good. And when that happens, that could have political repercussions, as Nathan alludes to. And the other thing to look at is a little statistic called reverse repurchase agreements, which is in essence borrowing short term, like overnight or 72 hours. In February of 2020, of 2021, that item on the Fed's balance sheet was zero. Today, it's almost $1.9 trillion. So the Fed's been creating money and then borrowing it back short term. How long they can do that game, or when are banks and money funds going to demand the cash as people borrow again because the money they got from the government during the COVID lockdowns is running out and prices are going up, and so people want the cash. This is uncharted waters, as they say, and I have no faith that the Federal Reserve knows how to pilot a ship in even chartered waters. Well, they don't know what chartered waters mean anymore. They just go anywhere.
Just one last thing. Do you see this lasting a decade like the 70s? Maybe just quick answer, yes or no, Nathan?
I think it'll be worse.
Well, I'll try to end on a happy note. I think unlike the 70s, where we didn't have all this social media and everything, immediacy, which has its downside, but the upside is people react far faster to things going badly. And I think there will be a counter revolution, starting with our book. They start to read that, and then all will be well.
Great final words, Steve. Fascinating discussion. We're coming to the end of our time together. Elizabeth, you did a masterful job managing that discussion. So thanks to each of you for your time. I want to encourage everyone to buy the book. If you wanted the best explanation of what's happening and what we should be doing to solve this problem, the book is your way to do that. And I see that it's a bestseller on Amazon, so you're off to a great start. This event will be posted to the Discovery Institute website, and so please share it with your friends, and lots of exciting things happening at Discovery, and you can learn more always by visiting discovery.org. So thanks so much for joining us. Thanks to each of our panelists for your time, and we'll look forward to seeing you at our next event. Thanks all, and take care. Bye-bye.
Thank you.
Thank you.
Thank you.